Hey guys, welcome to part 2 of our special podcast series where we're going to be talking about what to do when you've maxed out your 401. Essentially, what we're going to talk about today is asset allocation. How do you come up with your investment policy statement? What asset allocation makes sense for you? How do you pick between stocks and bonds and real estate? What does the asset allocation of ultra high net worth investors look like? And what role does, say, cryptocurrency and investing as an angel investor in your friend's device or your colleague's hedge fund have to do? What's the place for that in your portfolio? So let's go ahead and do a deep dive. Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review. If you're thinking that the only path to retirement is working harder, saving more, and investing in the stock market till you hit 65, I invite you to the 10x Your Financial Freedom Through Real Estate experience. This free virtual coaching event from September 7th through the 14th is going to be a game changer. And yes, I know that you can do it even in the current market with interest rates the way they are and even through a recession, because our students are doing just that. And on day 2, you get to meet some of them and hear their stories, how they have used strategies to get to 6 figures in passive income and save 6 figures in taxes in this market. So if you're tired, burnt out, and ready to take back control of your time and income, if you're struggling to get your first long-term or short-term rental and don't want to learn from costly mistakes, if you're ready to go from a handful of rentals to 10xing your cash flow, I'm going to go over my proven framework that I used to get to financial freedom at 41 and that hundreds of our members have used. Plus, we will be figuring out your action plan, taking into account your risk appetite, goals, and resources. We'll also figure out your next step to help you actually move the needle so you can accelerate to financial freedom while paying less in taxes and creating a recession-resilient portfolio. I want you to go ahead and register for the event at generationalwealthmd.com/event in lowercase, and I'll see you soon. Okay, so you guys, last episode we talked about figuring out years to financial freedom or retirement, right? To see if you stay on your current plan, how long is it going to take you to get to retirement, to see if you're on track. I would assume that the majority of us aren't really where we think we are supposed to be or where we want to be, right? Because I remember when I did this exercise in 2019, 2020, I was definitely not on track. So if you are in the same position, then join the club. What we're going to do is, this is where you have all the momentum you need to change your plan. And what we're going to do is we're going to talk about key concepts that are going to allow you to change the trajectory of your investing to get you to your goal retirement and get you on track, essentially. Okay. I mentioned this last time, but I want to reiterate this. 90% of a portfolio's long-term returns are driven by asset allocation, right? How you're dividing your money up between stocks, bonds, real estate, commodities. That asset allocation is 90% responsible for your overall returns, not the individual securities you pick. So if the big question is bank stocks or ARKK, that's not what's going to get you to your goals. Okay, so we're going to zoom out today and talk about your spread and the weighting of your assets, within your portfolio, because that is the most important determinant of portfolio returns. Now, this is going to be very, very personalized. And I say personal finances are personal, right? Investing is going to be personal. This is true for real estate. This is true if you're investing, just in stocks and bonds, whatever it is. It's going to depend on your goals. It's going to depend on your risk appetite and the resources available to you. But let's just back up a little bit and say, suppose you've maxed out your 401, right? So you know about tax efficiencies, and what we're traditionally taught is the first thing you do is max out your 401, right? And you may have invested in a target date fund within your 401. So a lot of what we're going to talk about is also going to be, how do you invest within your 401, right? Where is that money going? But let's assume you've done that. Let's assume you have a backdoor Roth IRA. And if you don't worry, we're going to talk about tax efficiencies. Assume you've done all of that. The question is, okay, how much of my portfolio should I invest in cryptocurrency? What about angel investing or any actively managed funds. So when we talk about your investment policy statement, your IPS, right, we're talking about asset allocation that is optimal for your portfolio. And the goal is to give you diversification, to also give you the highest risk-adjusted returns. We talked a little bit about this last time, because the returns are different for different asset classes, right? Significantly different. And then we're going to talk about tax efficiencies, because these three things, and that's our goal as we build up our investment policy statement. I always say this is something you sit down with your spouse or significant other, and you actually run through the exercise from part one, where you figure out your financial independence numbers. You run those numbers on the calculator. You look at what yours to financial freedom is based on what you're doing right now, and then you shift your plan together, right? So that's the goal. I did the same thing in 2019. I saw that the ROI of my portfolio was significantly lower, and it wasn't because I was primarily invested in equities or stocks, right? At that time, I had very minimal allocation to real estate. But the other thing that I was doing incorrectly is that I had a very large disproportionate allocation to fixed income assets. And if you remember, the returns from fixed income assets on average are about 5%. So that's a significant drag. That was a significant drag on my portfolio. And I realized I was saving for retirement, not investing for retirement. And I didn't have a roadmap. So your IPS, your investment policy statement, is your roadmap. When I shifted the guide and then I shifted my asset allocation, like I mentioned, whatever I thought would take me 3 years, I thought I would get, after that shift, I would get to retirement in 3 years. I got to my goals in a year. That's the impact of asset allocation. So again, just to wrap it up, when you create your IPS, you are thinking about three things, essentially. How much are you going to save? What percentage of your income is going to go towards savings? Then you think about your ideal asset allocation, where you want to be. And then you think about rebalancing, right? So how often are you going to look at your portfolio and then rebalance it to get it back to your target asset allocation, right? And this should not be an emotional decision. This is something that you decide and you stick to the plan. Otherwise, that's going to be one of the biggest financial mistakes you can make. Now, before we talk about asset allocation, and I'm not going to tell you what your allocation needs to be, but I do want to show you the difference between say the asset allocation of ultra high net worth investors. These are people with 5 to 30 million in their assets, right? And the average investor. So the average investor, that's like you and me, how we start out, right? Typically has about 50 to 90% of their portfolio invested in stocks, right? And I'm assuming the rest of that is like significantly in bonds or fixed income assets. Now, the ultra high net worth investor, they have almost half of their money in alternative investment, and real estate is a big part of it, right? And they have less than 30% in equity. So you notice the big difference over there? That's what I want to highlight. Now, let's go back to the returns of different asset classes, right? When we talked about stocks, we said, yes, ROI for a stock portfolio during growth is about 10% historically, because we're looking at averages over decades. And then when you go towards retirement for a stock portfolio, that number goes down to 4%. That's because to weather market volatility, you are shifting your portfolio from completely stocks to a mix of stocks and bonds, which lowers your ROI. But then you're also factoring in inflation. Once you factor that in, you are left with a 4% safe withdrawal, right? So that's your ROI from your stock portfolio. Fixed income assets, bonds, CDs, that's 5%. Cash is 2% on average. REITs, if you're investing in REITs, is about 10%, is the same as stocks. And so I always say, when you're thinking of adding alternative investments to your portfolio, and you're thinking of real estate, I don't really like REITs because you're adding diversification, but your returns are similar to a stock portfolio. So when I think real estate, for me, it starts from on the most passive end, syndications, right? Real estate syndications, where you're investing in individual assets or a fund, but you pick the plan where you have a value add plan, hopefully, and your returns are starting from about 20% annualized, right? So that's significantly higher, and you don't have that drop during retirement with your real estate syndication portfolio, right? So it's 20. And if you want to learn more about syndication opportunities that we have, go to generationalwealthmd.com/syndication. You have a free guide on there. You have our current syndication offerings. Right now we have Park 33. We're closing down. We have a few spots left. So if you're interested in listening to this while this is coming out, which is the end of August, then definitely go check it out. We also have our current syndication offerings on that website at all times. So syndications are about 20% average annualized returns. And it's similar if you have a buy and hold long-term rental. And then once you get into more active real estate, like short-term rentals, and mid-term rentals, you can go all the way up from 50 to 200% ROI in year one. If you want to learn more about investing in real estate the right way, or at least dipping your toes and understanding concepts so you feel confident in what you're doing, join us for our 3-day live event that's coming up September, the first 2 weeks of September. It's generationalwealthmd.com/event. Very high yield, 3 days. We have some of our members from our program, Creating Generational Freedom, coming on to talk about their journey, so you hear multiple perspectives. I'm super excited about it. This is for someone who's just starting, and it's also for those who are looking to scale their portfolios. Very high yield. I'd love to see you on there. But that's what returns look like across the board, right? And then you have, real estate has the highest risk-adjusted returns, which lowers your years to retirement. We saw this last time. And then you have commodities and cryptocurrency. Now, I feel like someone who's very conservative, in a conservative portfolio, cryptocurrency would probably be 1 to 3% of your overall asset allocation. That's my opinion. And everyone's going to have a different opinion, but I wanted to put that out there. But those are the different assets, and it's up to you to decide how you want to allocate among it. I'm going to give you some rules of thumb. If you have a primarily stock bond portfolio, the rule of thumb is 120 minus your age. So if you're 40 years old, you would have 80% of your stock bond portfolio, 80% in stocks and 20% in bonds. And as you grow older, you're going to shift that. And like I said, that's because you want to weather market volatility, right? That's just a rule of thumb most people use when they try to think about asset allocation in stocks and bonds. Now, like I said, as you introduce alternative investments, and real estate is considered an alternative investment because most financial advisors aren't really allowed to talk about it. But if you look at ultra high net worth individuals, like I said, 50% of their portfolio is in alternative investments. So, it's just terminology. Real estate, I think, is a powerful wealth builder. It's a powerful tool for generational wealth. But that's a whole different ballgame. If you talk about a traditional stock bond portfolio, you could use the 120 minus age rule. So it's a general rule of thumb that you could use to decide on your stock bond portfolio. Now, typically, if you're investing in stocks, I know people like picking individual securities. That's what I did when I started out. But a very safe way to get consistent returns is if you pick passive index funds instead of going with an actively managed fund, right? So Vanguard, Fidelity, they have passive index funds where the expense ratios are really low, which means that it really significantly increases your returns when you're investing in stocks. And there are studies to show that less than 4% of actively managed funds beat the S&P 500, right? So the chances of someone with an actively managed funds between fees and transaction fees that they're paying, the chances of them beating the S&P 500 are very, very low. So I want you to keep that in the back of your mind. You don't want to be paying someone fees. You can pay someone fees for superior returns. If your returns are essentially going to be significantly higher, this is what we see in real estate, you can do that. But you don't want to be paying fees for inferior returns. So be very intentional about where you're parking your money. And then Jack Bogle, the founder of Vanguard, he said this: when you go with an actively managed fund, oftentimes you're losing 67% of your returns and fees. So at 7%, right, if you're getting a 7% return over 50 years from a stock portfolio, $1 becomes $30. But if there's 2% fees, that's what you're paying your managers, your fund managers. With that 2% fees, your return drops to 5%, and that 5% over 50 years means your dollar becomes $10. So you're losing $20, so you're losing 67% of your returns and fees. So be very intentional about that. That's something I always like talking about. The next thing I want to quickly, because we're doing this like really quickly, right? We're going to talk about how do we pick something. For most of us, it's like, okay, I go in there and I get overwhelmed by everything that's available on there. And I want to talk about, how do you keep your portfolio simple? And there is the 3-fund model and the 2-fund model. And this is purely for those of you investing in stocks, right? If you're thinking about stocks, this is how I want you to think about it. So with a 3-fund model, to keep it very simple, you invest in 1, a total U.S. stock market index fund, and 2, a total international stock market index fund, and the third one's going to be a total U.S. bond market fund. So you have a complete stock market exposure, which is large cap and small cap stocks, then you have international exposure, and then you have, exposure to bonds. That's your 3-fund portfolio. How you split your assets over there, that's also going to be based on your risk appetite and how you like things. Some people do a 33% split between all of those. Others allocate differently, whatever makes sense for you, right? Now, a simpler way, if that seems complex to you, I use the 2-fund portfolio. I don't really have small cap or international exposure in my portfolio. I feel like there's more volatility there, and over decades, I've noticed that the returns are very similar to, say, the S&P 500. So a 2-fund portfolio would just be, you get one S&P 500 index fund in there, and then you have a total US bond market fund. That's a simple 2-fund portfolio. Whatever you put into your 401, go in there and take a look at it. If it's in a target date fund, some target date funds have high fees, which means you're losing a significant portion of your returns, like that example we just talked about, right? So I want you to be intentional, even within your 401k, to go in and say, this is where I'm currently invested. This is what I want to be looking at. And that's why we're doing this, right? So that's how you would allocate within a brokerage account or within a 401k, right? And again, this is all just purely educational. These are my opinions. I am not a financial advisor, but these are rules of thumbs that are, considered pretty conservative in the finance space. And this is what I tend to follow also. But once you do that, you then have, what percentage of your income do you want to have in fixed income? That's bonds and CDs. And it's very important to be intentional about it and actually write this down on your IPS. And then you come into, and I feel like I want to reduce the barriers for people to have real estate in their portfolio, which is why, we started talking about real estate in Generational Wealth MD, talking all about active investments, active investing in real estate. And we're going to talk more about that during our 3-day live event, generationalwealthmd.com/event lowercase. Make sure you join us. If it just goes over everything you kind of need to know to build your own criteria for how you're going to acquire real estate. But we realized that a significant portion of people don't want to invest in real estate actively. So you have the option to do that passively, where you put your money in, and as operators, we go in and we take the project to completion, we execute the business plan. That's where real estate syndications come in, where you're still getting significantly higher returns, and you have diversification, but you're having those tax efficiencies, and you're able to stay passive and still have a velocity of growth, right? And so again, that's generationalwealthmd.com/syndication. If you want to get started, all lowercase. You have a free guide over there, which talks about kind of everything you need to know about investing in syndications. How do you build your own criteria even over there? And then we talk a little bit about it even during the live event. So those are 2 resources for you. Now we've talked about, okay, what is my savings rate going to be? How do I want my assets to be allocated, right? Those are 2 important things. And tons of resources. If you're trying to dip your toes into real estate, you have the ability to do that. It isn't as challenging as it seems. Anyone can do it, and there are different ways of doing it, right? So that's what I wanted to expose you to. But then finally, I also want you to think about, when you're thinking about asset allocation, think about tax efficiencies, right? So the location, it's not just about asset allocation, it's also about asset location. So let's talk a little bit about asset location, right? Now, if you're someone who wants to invest in equities, right, stocks, and you are investing in your 401k, you max that out and you're investing, that's where you're going to hold your stocks, fine. If you are then going to take money and put your post-tax money into a brokerage account, I want you to also think about a backdoor Roth IRA. So most of us in residency, if you're in residency listening to this, that's a great time where your income is low, where you can use a Roth IRA and allow your money, you can fund it more extensively, right? Within a Roth IRA, your money is triple tax advantaged. So you put pre-tax money in there and it grows tax-free, and then you can withdraw from it tax-free, right? So it's super tax efficient. Once your income hits a certain threshold, you're only able to do a backdoor Roth IRA, and it's a pretty straightforward process. You can actually Google it. You put your money into an IRA, and then you transfer it into a traditional IRA, and then transfer it into a Roth IRA. You can put, I believe, up to $6,500 for you and your spouse into it every year. And if you're going to put, say, $12,000 into a brokerage account, your post-tax dollars are going to go into a brokerage account. I would highly recommend seeing if this makes sense for you, because a backdoor Roth IRA, you put the money in there. You've already paid taxes on it with a backdoor Roth in this case. But what happens is that, even when you do it initially, right, a Roth IRA, when you're in residency, say, and you're putting money in, you're in a significantly lower tax bracket, right? So you're stashing money out there, and then it grows grows significantly, but as it grows, you don't have to pay taxes on it. And you are able, after 5 years, to withdraw your money from that Roth IRA. So it's all post-tax dollars going in, but you are able to withdraw that money after 5 years and use it if you need to. So whatever you've contributed, you can withdraw. You can't withdraw the the money that has grown essentially. But after a certain age, you're able to tap into that money and it's grown tax-free and you don't have to pay taxes on it. So it does add a lot of velocity to your portfolio when you use a backdoor Roth. Something to think about. There's something called a pro rata rule. If you do have an IRA, like a traditional IRA, you may not be able to tap into it optimally. So make sure you run that by your CPA. But if you don't have a traditional IRA, then a backdoor Roth is something to consider if you are going to invest post-tax dollars into equities, into stocks, right? So that's one way of doing it. Now, the second thing is an HSA. If you have the ability to tap into an HSA, remember that you're stashing money over there. That is essentially pre-tax dollars that you're putting in. But after the age of 65, you can withdraw that money and use it for any expense without a penalty. So there's a significant advantage over there if you're able to stash money over there. Something to think about if you are investing in REITs. Now, I say for me, real estate stocks from syndications going all the way to short-term rentals. REITs, I don't really, they're not tax efficient. They don't necessarily give you the same returns. But if you are investing in REITs and you are investing in debt funds, right, then those you want to hold within a tax-deferred account because they are tax inefficient. And it makes sense to hold them within tax-deferred, tax-advantaged accounts, right? It's the same thing for bonds because you get your returns from bonds will be taxed, so you're better off, and high dividend stocks also, you're better off holding these asset classes within tax advantaged accounts. If you have international funds you want to hold those in a taxable account because you do get a foreign tax credit, right? So as far as tax location is considered, that's something to think about. When we're talking about tax efficiencies within your portfolio, I also want you to think about a 529 plan. When you are investing in a 529 plan for your children, I want you to think about if they have earned income, you have the ability of also funding their college expenses through a Roth IRA if they have earned income, right? Now, this is true for a lot of our members who invest in real estate and their children, after a certain age, start assisting them. They can pay them because it's earned for any age-appropriate task that they are performing. And as long as the compensation is, what you would traditionally pay someone else, that can go into a Roth IRA. This is called income shifting. You take it away from your taxable income, you're paying your child. They don't have to necessarily pay taxes on it up to a certain amount, which I believe is the standard deduction is $12,000 at this time. They don't have to pay taxes on that income, and it grows tax deferred. So that's where you get that triple tax advantage, right? With the HSA and a Roth IRA for a child, say, when they're under that $12,000 limit. This is something that our members who invest in real estate can take advantage of. And then your child can use that for buying a first home or for healthcare expenses, or they can use it for college expenses when the time comes. But that is a very powerful vehicle also. So that is tax efficiencies. That is something about asset allocation and asset location, right? Those are things I want you to be intentional about when you're building out your investment policy statement. And then finally, I want you to think about rebalancing. Where do I want my, at every stage of my life, what do I want my asset allocation to look like? Once you write this down, this takes the emotions out of it, hopefully, right? You don't override this. When you're seeing market volatility, you stay unemotional, and you could be rebalancing dynamically, which means when you have new money, you're putting that into the asset where you want your allocation to increase, or you can shift that money. Oftentimes, we're just dynamically rebalancing, which means we're not selling one asset to put it into the other. What we're doing is we're funneling new money into the asset that we need to see more of an allocation in, right? This is really important to really write this down and stick to the plan. So hope that covers almost everything you need to build your own investment policy statement. Hopefully this was super helpful. What do I do once I've maxed out my 401? Now you have a plan. This plan should hopefully get you to your target retirement based on the retirement calculator numbers that we ran in episode 1 of this series. So I want you to write this down, pen and paper, and make sure that you're on track to retiring on your schedule, right, on your terms. But what I notice is that even with all this in place, sometimes we're sabotaging our own retirement by making financial mistakes that are prevalent, right? Most of us make at least a few of these mistakes. So the last part of this podcast series, we're going to go over the most common mistakes that we make that jeopardize our retirement, and other blunders that we tend to make as a group. And they just happen to be super easy to fix. So as long as we're aware of what we're doing, I'm hoping there is a huge impact. So I will see you in part 3.